Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney, where markets have just come online. The top stories this hour. A cautious start ahead for Asian trade after Wall Street gets a reality check. Hotter than expected US inflation triggering a slide in stocks and bonds, with swaps traders reducing bets on a Fed cut before July. Lyft shares soaring after the bell as its earnings outlook exceeds expectations. Airbnb, though, slipping despite a strong quarter and an optimistic forecast. But let's get you straight to these markets. And it was that reality check that the feverish bets on sooner than expected and perhaps more hefty than expected Fed rate cuts were really pared back, with traders now ratcheting down expectations for a cut before July. We saw Treasury yields soaring after, of course, that inflation report really telling us that price pressures remain sticky in the US. And this is a picture as we look across to the side of trading here in Asia, really set to slide. We're seeing downside already in the staggered open here in Sydney of 0.3%. We'll be following the losers, if you will, after that hotter than estimated US CPI print triggering that sell-off overnight. We're seeing Australian yields also playing catch up or catch down, if you will, when it comes to what we saw with Treasury yields jumping in the session as well. We see swaps contracts referencing Fed policy meetings, which as early as mid-January had fully priced in a rate cut in May and 175 basis points of easing by the end of the year. They've really been turned upside down, with the odds of a May cut now about 32% from 64% before that data was released. We're seeing some moves when it comes to the US dollar there as well, with the Aussie dollar pretty unchanged at the moment at 64.53. When it comes to futures, looking ahead to the start of trading in Japan, equity futures for Tokyo seeing declines of more than 1% potentially when we get to the open. And we are watching, of course, JGBs as well. 2-year Treasury yields particularly surging to levels that we haven't seen before that December central bank pivot. And we're watching the dollar at the moment still pretty close to a 3-month high. And we're seeing dollar yen now firmly above that 150 threshold. If it stays there, of course, 150 being key, given that's a threshold where we would typically potentially see some room for intervention. And in fact, we are really getting some remarks from Japanese officials at the moment. The currency chief, Masato Kanda, speaking in Tokyo, saying the rapid FX moves have had a negative impact on the economy. Appropriate steps on FX will be taken. The yen edging higher as Kanda is speaking. The Forex chief saying they're always ready to take measures 24 hours a day, 365 days a year, and that the 10-year yen move, a 10 yen move over 1 month is considered a rapid one. So we'll be watching certainly yen as a key story, but also a quick note when it comes to what we're seeing when it comes to US futures, potentially maybe a little bit of a recovery across the sort of growthy end of the spectrum. Nasdaq 100 looking a little bit more positive. Of course, some of that could really see a bit more of an impact given the big rally we've seen in tech, and given now the expectations of easing have been pared back. Crude off by just about 0.1% in New York. We have seen mostly higher trading for oil, bullish demand outlook from OPEC helping surpass that key technical level, which has been a bit of a ceiling for trading in oil. But let's get back to the inflation numbers. Our global economics correspondent, Enda Curran, is with us in Washington. And Enda, you know, this was always a concern, right, that this final leg of the journey would be stickier and more volatile. What was your main takeaway from the numbers?
It wasn't a good inflation reading. Headline and core both coming in faster than expected. Heidi, the price for food up, price for shelter up, price for healthcare up, price for car insurance up. All of these staples that people spend on here on a monthly basis, all continuing to head in the wrong direction. The good news side of the ledger is that there are pockets of disinflation, in particular energy is a real drag on the overall rate. But the bottom line is that this year of disinflation, or this narrative of disinflation, certainly has been given some pause for thought today. It does speak to the idea that this last mile is going to be the hardest. And when you consider the backdrop that the jobs market is strong, consumer sentiment is strong, and now inflation is pretty, is remaining quite sticky, it does demonstrate just how hard it's going to be to get inflation back to the 2% target.
What are the implications for the Fed? I mean, we know the repricing that's going on at the moment for markets.
I think so. The Fed, I guess, in their defence, have been preaching this idea that they are going to be careful about any rate cuts. In fact, at the last press conference in January, Chairman Powell made the point that they have to be confident inflation is coming right back to where they want it to be. Well, you'd have to wonder how confident they are going to be after today's reading. As you know, of course, the idea of a March cut has kind of been pushed aside some time back. Traders in the money markets now tossing their bets around whether it's June or July. But the point is, it speaks to the idea that those near-term Fed rate cuts don't look likely now. And, there may be some one-off factors in the January reading. There may be some seasonal impacts behind it. But if we get another, say, sticky reading in February and maybe also for March, then it's the whole Fed story and the whole inflation story here is going to have a very different hue. So I think right here, right now, people pouring water on near-term Fed rate cut prospects. But I think if we get a few more reports like this, it'll become an even more uncertain picture as to when they can actually cut.
And of course, it's a big political year, right? Does this potentially become an election issue?
Well, I think it has to feed into the political cycle here, and of course, voter opinion, Heidi. I mean, we are getting opinion polls, including our own Bloomberg opinion poll, that say voters in the swing states, for example, one of their top primary concerns is the economy, and within that, it's the cost of living. And now you have this inflation print saying that people are out there actually paying more again in January for their goods than they would have been in a previous month. That doesn't necessarily lend itself to a fairly content voter base. It is on the radar of the politicians here. We know it's front and centre in this campaign. And as I mentioned in the earlier thing, just like the Fed sort of side of this debate, if we get a few more months where it looks like inflation is going to stay elevated at best without getting into the argument over re-accelerating, well then that is going to drive home this cost of living story for voters, that it isn't going away, and you would have to assume it'll be part of the debate. Of course, the US administration pushes back that they are taking the steps and measures required to try and iron out some of the supply side chokes in the economy, but here we are in January of election year and the inflation data still doesn't look especially comforting.
Our global economics correspondent Enda Karan there in Washington. Let's get the market's reaction and some perspective with our next guest. Hebe Chen is a market analyst at IG. She's with us now. Hebe, great to have you with us. So our pending expectations, which, of course, I suppose the irony here is that the signalling from the Fed was that this last leg of the cycle was not necessarily going to be a one-way track, right? Do your expectations for easing still hold when it comes to the time frame?
Well, I think, yes, I agree. Today's inflation CPI is definitely hot, but I don't think that's get to the level about the quite too surprise. It's because that on the one hand, we do seeing that historically often the final mile of inflation will be quite bumpy because we know that the most sticky components often those one that left to the last. But on the other hand is, I think what the immediate direct impact of today's CPI is it officially and convincingly moved March cut out of the table, which is also in line with what the Fed has been trying to convince the market in the past couple of weeks. In terms of whether or not will meaningfully flow impact for the meetings after that, I think it's definitely yet too early to making the assumption there, because we're going to have another inflation indicators just coming through by the end of this month, which is the PCE. After that, I think that will reflect on the March meetings projection from Fed, what they are seeing the pathway will be. So before now until June, I think there's quite a lot of uncertainty there. So at this stage, I won't say that the June cut is off the table yet.
So how vulnerable are valuations, particularly if you take a look at US stocks?
Well, I think that it's today's reaction or market's reaction sort of reflecting that the market's been pricing in the Goldilocks scenario is now in question now. So the market's been pricing in the March, now being pushed back and pushed back. That was definitely impacting on the market sentiment. And especially given we have seen the US dollar is coming to such a high, lofty level, a bit of the retreat or reflecting the reality, I think is very likely on the cards. But however, given how the cut, or mainly because the market was definitely quite shifted into a new reality layer, and plus the earnings for the past Q4 earnings also demonstrate the strength in the US economy. So overall, I'm still quite positive for that. But before now and when the market really get into the reality, I think there's some of the bumpy road or bumpy paths for the investor have to go through.
And of course, it's earnings season here in Australia as well. And you say it's kind of whatever we get out of this reporting season is being overshadowed by the inflation picture and the expectations for the RBA here.
Yes, exactly. So we already have a couple of the earnings from the Australian companies. I think one of the key takeaways so far I have is we are seeing a falling, actually it's quite dipping profitabilities from Aussie businesses, especially for the big companies like retail. JB Hi-Fi, for example, they're seeing the profit dropping about 20%, Nick Scotty dropping 20%, and today's CBA as well. So what this suggests to me is that even that we're seeing the inflation has dropping quite substantially from the second half of 2023, the reality is that now what this squeeze really squeeze the company's profitabilities. It's not just coming from the rising material prices, labor prices, but more into the changing consumer behaviors there. So that will likely to have quite a lagging impact on the profitabilities for the Aussie business.
I want to get your views on Japan and the yen in particular, given that we've seen now that sort of strength being re-injected into the US dollar. And we've seen some comments, given the big move in the yen from Japan's currency chief, Kanda, just saying that they're in close communication with the Bank of Japan. They don't take FX action based on specific levels, but that the 10 yen move over 1 month is indeed rapid. How does this potentially play into what we see with the market, given the weakness in the yen has been such a supportive factor? Do you expect more intervention?
Well, actually, I have to admit, I think the weakness of Japanese yen is quite longer than what I expected at the early of this year. On the one hand, we do hear quite a lot of the message coming from the Bank of Japan. They are patient, they're still patient about their monetary policies. But on the other hand, I think even if looking from the economy point of view, we're seeing that the strength of Japanese economy. But on the other hand, we also see some of the variation. We're seeing that the Japanese economy dipping in the final quarter of 2023, but now we're seeing it picking up a little bit, but definitely not as strong as the most time in 2023. So I think that will be an underlying concern for the Bank of Japan to saying that, okay, now we are exit the relaxed policies and that what they could support the economy, and that's exactly what their priority they're looking for. So I think from all this consideration, I would expect the weakness of Japanese yen will probably last for a bit longer than what we expected and most investors hope for.
Haidi, always great to chat with you. Haidi Chen, market analyst at IG. Still ahead, the world's biggest one-day election is underway with around 200 million Indonesians choosing their next president and parliament. We're live to Jakarta next. This is Bloomberg. Well, more than 200 million Indonesians have begun heading to the polls in the world's biggest single-day election. 3 candidates are vying to succeed President Joko Widodo and set the course for Southeast Asia's biggest economy. Our chief international correspondent for Southeast Asia, Haslinda Aman, is with us live covering the election from Jakarta. And Haslinda, I guess set the scene for us. What are the expectations? What's the mood from Jakarta, and what are we looking ahead to?
Well, to start with, Heidi, it is a massive election. It is complex. You talk about 200 million voters in an archipelago with 17,000 islands, 700 languages, 3 different time zones. And just to give you a sense of the terrains, we've had millions of election officials getting deployed. Some have had to leave days beforehand to get to the location on foot, on horses, even on helicopters, to get to the most remote areas to ensure that the voters get the voting papers. So it is a massive undertaking for the country. It is complex. It is as complicated as it can be. Now, we talk about the 3 candidates vying for the top job. It is not just about choosing the president, but also the government, the local leaders as well. So this is a huge election. Now, it is Prabowo Subianto's election to lose. He is the favored man to be the next president to replace Joko Widodo. Now, he has a pretty checkered past. Back in the 1990s, late 1990s, he was the man, a general linked to the abductions of student protesters who some didn't quite appear again. He's also the man linked to the human rights violations in Papua New Guinea, in East Timor, and he's always denied the allegations, but he was let go as a general. He spent a year in Jordan in exile. He also was on the blacklist of the U.S. for years until recently when became the defense minister under Joko Widodo's second term. So a man with a checkered past, a man quite controversial, but what a stunning turnaround. He is the favored man. He's been backed even by Joko Widodo himself, and hence his popularity has surged. Remember that an endorsement by Joko Widodo, even though unofficial, means a lot. Joko Widodo, in his final term, has managed to garner a rating of more than 80%, a very popular president, and that has somehow transferred to the man of the hour, I suppose, expected to win in a single round. Remember, the winner needs about at least 50% of the national votes, but at least 20% of the votes in the provinces. So it is a massive task. If he manages to win in one round, it will be a big deal. It will send a signal of continuity to the markets.
Yeah, as you just pointed out, Prabowo is the continuity candidate, and whoever wins, it inherits just an economic behemoth, right, in terms of how the Indonesian economy is going. What are the issues, though, as we head towards and look towards the post-Jokowi reform era?
Well, it is about reforms. It is about continuing with the policies that he has adopted. Remember, in the last 9-10 years of Jokowi's administration, he's managed to bring stability, and that is important, stability to the economy. It's grown an average of about 5%. He has managed to attract a lot of foreign direct investments. Just last year alone, he attracted about $50 billion, a quarter of which went into downstreaming, nickel downstreaming, which is a priority for his government, EV sector. And you know what? This is the man who's built more infrastructure than all the other presidents before him put together. Now, what investors want to see is continuity, and the three candidates broadly have promised to continue with his policies with tweaks here and there. But what people want, what investors want to see is Jokowi 2.0. Better implementation, better jobs being created. Remember that we had an explosion of a furnace recently, which became a flashpoint among the people because they were complaining about how, despite the investments pouring into the country, jobs, the quality of jobs are not there. So the three candidates, whoever wins, will have to ensure that better jobs are created and that growth can get to the 7% that the country wants it to get to by 2045.
Our markets co-anchor and chief correspondent for Southeast Asia has Linda Arman there live from Jakarta. We'll get more on the Indonesia elections here on Bloomberg TV. Has is on the ground for us, of course, but you can catch our conversations with the consultancy group. Alvarez and Martel, as the former Indonesian finance minister, will be along with us, and the chairman of the board of Indonesia Financial Group later on. Another political story that we're following closely, in Pakistan is inching closer to getting a new government after Shehbaz Sharif was named the country's next prime minister candidate. He was nominated by his older brother and the three-time former prime minister, Nawaz Sharif. Last week's election saw no political party achieving an outright majority. The top task for Pakistan's new leader will be to negotiate with the IMF for the new loan program. Well, China is lashing out at a new proposal from the EU to possibly sanction about 24 firms, including 3 from China, accused of aiding Russia's war in Ukraine. For more, let's bring our chief North Asia correspondent, Stephen Engel. And Steve, what do we know about what's being alleged and what these companies are?
Well, we do know, of course, that China has been trying to improve its relations with the EU at a time when there's been a number of different probes back and forth between the two trading blocs. Obviously, there's the electric vehicle probe that has been launched by the EU on China. You have China also having its own investigation into, EU liquor products. And then there's the whole back issue about semiconductor equipment machines from ASML, kind of the Netherlands government government teaming up with the United States to help limit the advanced chip-making equipment to getting into China. So there's a number of different trade issues at the fore of trade relations between the EU and China that has turned into a political fight. Now what we have is another EU proposal coming from Brussels, essentially to potentially, if it's approved by member states, to put sanctions on at least 24 firms around the world, including 3 in China, as you rightfully said, but also a firm in Hong Kong, a firm in India, also Turkey, Syria, and others, essentially trying to punish firms that are using third countries, essentially to get equipment or some sorts of materials, this is what's accused or alleged, into Russia to aid its war in Ukraine in violation of sanctions. So again, this could be potentially more sanctions. China, the Ministry of Foreign Affairs, put out a statement essentially blasting this effort, and I'll read you the statement, essentially saying Chinese and Russian enterprises carry out normal exchanges and cooperation and do not target third parties, nor should they be interfered with or influenced by third parties. Beijing will take necessary measures to resolutely safeguard the legitimate rights and interests of Chinese enterprises. And basically, in that statement, they use words like firmly oppose what it called illegal sanctions. Now, keep in mind, the EU tried to do this before, but member states were, I guess, their fears were assuaged by Beijing's insistence that they were not providing any kind of military aid through, government channels or its enterprises to Russia to aid its war in Ukraine. So they backed off on that. That's why this one is such an interesting development as the EU pushes forward potentially to put sanctions on at least 3 Chinese companies.
Our Chief North Asia correspondent Stephen Angle there with the latest, and you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can find that at Daybreak Go. It's also right there on the mobile in the Bloomberg Anywhere app. You can customize those settings so you just get the news on the industries and assets that matter to you. This is Bloomberg. You're watching Daybreak Australia. The latest corporate stories that we're following, and Lyft shares trimmed gains of as much as 67% in extended trading after issuing a massive correction to its earnings margin outlook for 2024. The company now says the margin is expected to expand by 50 basis points, not the 500 basis points written into an earlier press release. The Uber rival sees first quarter gross bookings of up to $3.6 billion against the average analyst estimate of $3.48 billion. Airbnb is giving an optimistic outlook for the start of the year, fueled by growth in international markets. Executives told a post-earnings conference call that they're starting to see overall demand normalise after COVID. The company sees revenue in the first quarter up to $2.07 billion against estimates of $2.02 billion. US grocery delivery giant Instacart is cutting hundreds of jobs and restructuring its leadership team. The announcement came as it reported a slight revenue miss for the December quarter. The 250 cuts affect about 7% of the workforce as the company shifts focus to higher margin businesses like advertising. Coming up next, we're live back in Jakarta asking a global consultancy what investors should watch out for in the presidential election. Take a look at how we're tracking so far in what is expected to be a pretty difficult session, given we saw the sell-off on Wall Street, the reality check, if you will, with that hotter than estimated US inflation data triggering a repricing of Fed expectations and easing expectations throughout the session. That's expected to percolate through to Asia. We're already seeing downside of 1.25% here in Australia. Pretty robust earnings overall, but of course we are really seeing the broader sort of macro expectations picture playing a bigger role there. And we're seeing, in particular, watching the likes of CBA trading in Australia after we saw profit and dividend topping estimates. But of course, this is a year that is dominated by politics, and we're headed to Indonesia's election. Our chief international correspondent for Southeast Asia, Linda Armin, is on the ground in Jakarta on election day with our next guest, Haz.
Well, that's right. It all kicks off in about 30 minutes, 7 a.m. local time. It ends at 1 p.m. So all the voting, all the 200 million voters will have to vote within that 7-hour time frame. Let's put perspective, talk about the policies. Alessandro Gazzini, head of Indonesia at Alvarez and Marshall, which is a consultancy. Alex, good to have you with us. It is quite amazing how this election is going to take place within a very short period of time.
Yes, 70,000 voters a minute, basically. It's a very small window, as you were mentioning before. Massive archipelago, right? So it's a feat of logistics, electoral logistics itself, right, to pull this off. And the government has proven in the past and will prove today that it will pull it off, yeah.
It is about policies, continuity of policies. Will we see that regardless of who wins?
I think broadly what you can see is what I would say is the Jokowi economic sauce, and maybe variants of that sauce will come out depending on who makes it in the final run to president. But broadly, the pillars of the development plan and so on are set. And also, the candidates themselves participated into government up to a few months ago, most of them. Even the most opposition candidate, Anies himself, was in the beginning in government, right? And the track record of Anies himself is not a revolutionary changer of setups, right? So broadly, I would say the scenario is painted.
The man favored to win is Prabowo Subianto, a man with a checkered past, but has seen quite a turnaround. He has said time and time again that he'd like Indonesia to go back to the 1945 constitution. What exactly does that mean, and what's the risk of that happening?
I'm not too sure what he really means by that. I guess it's back to the roots of stronger nationalism and stronger pride of country, I guess. Economically, I don't know what that would mean, imply today. But broadly, he has proven to be, in government at least, a relatively safe minister with tensions, perhaps with the Ministry of Finance, right, in terms of spending, right? I think what will be interesting to see if he does turn out to be elected president is that how will the relationship evolve between him and Jokowi? What MOF and Bank Indonesia infrastructure and people and leaders will he place, right? Because the truth of the matter is Indonesia has had a successful policy also because of the sturdy and successful management of the macro fundamentals, right? So what is he going to do there, right? And thirdly, is he going to have the skill that Jokowi demonstrated in essentially controlling parliament? So he will have to. That's a scenario that we will see in the coming months.
Which are the policies which are the most important for investors? I mean, Jokowi made EV a priority. He made infrastructure a priority. He made moving the capital from Jakarta to Nusantara a priority. Are these the ones that investors are focused on?
I would say investors, first of all, are focused on macroeconomic stability of the country and rule of law first, because the country is full of potential. So investors are moving in not just on the infrastructure side. They're moving in on digital assets. They're moving in on consumer good companies. And the sentiment is generally positive. So first of all, to ensure that the macro fundamentals of the country and wealth is being distributed into the country is the main point. Then, of course, large investments need large programs. Jokowi went through the first cycle of energy investments. You might remember the 30 gigawatt program. Unfortunately, that was mostly done in coal. So now it's a problem Indonesia needs to solve, all of this coal. And the infrastructure has been the second wave, and investors piggyback that, right?
We talk about how we're also looking for Jokowi 2.0. People want better policies, better job creation. There's been a lot of dissatisfaction among the people that, even though we're seeing an inflow, massive inflow investments, the quality of jobs is not there. Can someone like Prabowo ensure that happens?
That's the key point, right? Indonesia, if you look in the past few years, is navigating about 1 million, maybe 1.5 million new jobs created a year, right? And this is a country that does have the potential to look at 6% growth, 7% growth. That implies that the country needs to create at least 3 million jobs a year, right? Where will they come from? So far, the electoral politics and campaigning hasn't really answered the question of how. How will I create these jobs, right? And that's the big question to be answered, right? Because at that growth rate, you need those 3 million jobs, right? Are they going to come from maybe state women or state enterprise reform? Or are they going to come simply from the downstreaming of the processing industry? Won't be sufficient because those investments are highly mechanized, right? And they're automated and won't create jobs for the whole population.
Prabowo, favorite to win, 72 years old, not in the best of health. What's the risk of having Prabowo as president?
Well, obviously, if his health should have challenges and problems, right? The rule of law here is for the vice president to step in. And the vice president, of course, is the son of the current president. So I would say if that in that scenario, we would have a much stronger a Jokowi 2.0 de facto, right? Really, father and son governing the country, right? So that's what I said in the beginning. It would be interesting to see how, when elected, if and when elected, Prabowo manages this relationship with Jokowi. How will it evolve? Who will be really taking the fundamental decisions, and how will Prabowo set his course rather than just simply replicating Jokowi's vision, right?
Alex, thank you so much for your insights today. Alex Gazzini there, and Haidi, of course. Big election here in Indonesia. 200 million voters set to cast a vote starting from, well, in about 20 minutes from here.
It's going to be quite the day. Our chief international correspondent for Southeast Asia, Haslinda Amin, is there in Jakarta. And of course, we'll bring you a lot more when it comes to the Indonesia elections here on Bloomberg TV. You can catch our conversations with the former Indonesian finance minister, the chairman of the board of Indonesia Financial Group as well. That's happening a little bit later on. But still ahead, Japanese stocks are in focus. Benchmark Nikkei index edging closer to an all-time high. We'll be taking a look at today's open next. This is Bloomberg.
This is a bit of a bruising CPI report.
There are certain aspects of this report which push the numbers higher.
It's not good news. We would have preferred to have seen something a little bit less than that.
This is not bad. It's just cooling more slowly.
That last mile of getting down to target after rapid deceleration is proving to be a little bit chewy.
There's a lot of things that the Fed is not going to like about this.
It does complicate the messaging and the decision-making for the Fed.
We now had to punt on rate cuts further into the year.
I think that the Fed has been trying to guide the market narrative to expecting less this year.
The Fed will not be cutting rates as much as the market expected.
Is a rate cut going to happen in March? Knowing what I know right now, probably not.
We're still thinking we'll avoid recession, so 3 rate cuts is what we get.
May is still a long way away. We still have a long data between now and May, and we'll see how the whole totality of the data pan out between now and then.
Bloomberg TV, Gaseb reacting to the latest US inflation numbers. Let's take a look at the reaction when it comes to the FX side of things, because we had the US dollar sort of barreling towards that 3-month high with the repricing of Fed expectations and the pullback of these easing expectations, of course, front and center in terms of the trading themes for today. Dollar yen is really firmly above that 150 threshold, which is significant. Of course, 150 typically has been where we've seen that risk for intervention rise. And we did hear from Japan's top currency chief, Masato Kanda, a little bit earlier as well, with a bit of verbal jawboning and a reminder that a weak yen is not a one-way bet, so don't be complacent there, if you will. The Aussie dollar, 64.52 is where we're sitting, and watching dollar China as well, as, of course, we head back into the start of trading after the Lunar New Year holidays, and we are expecting, if the Golden Dragon Index in the US is any guide, to see that resumption in the Year of the Dragon with some pretty downbeat sentiment there. Our FX and rates reporter Michael Wilson joins us now here in Sydney for more when it comes to the big story, obviously, is the yen and whether at this point 150 means something.
I think that it's just at this stage it's just a number. The old high, just shy of 152, is probably where people will be seeing as the line drawn in the sand by Cantor. Yeah, he made some comments today, but I think that was more of a drive-by. I don't think he really expected. He was just checking out the market's reaction function really. He wasn't expecting like a 100-point drop or anything like that. It's like when countries fly into other countries' airspace, they just want to see whether they scramble or whether they just keep watching on radar. So we went down 20 points and up 10. So I don't think the market's too comfortable. And look, the ink on that hot US inflation print is still wet. The market's still repricing that caught everybody by surprise, and so it would be on today. The day after that print, I can't see Ministry of Finance pulling a trigger and actually intervening, but I do think it's not actually in their interest anyway. I mean, they would like to see in the run up to policy normalisation, they would like to see, I think, dollar yen somewhere around 150, maybe a little bit above, because when they pull that trigger, it's probably going to get about a 1,000-point response. So for now, they'll just keep watching it, just as markets are as well. And if we see a sudden move, like where people just try and take on a level towards that 152, well, you might see the jawboning become a little bit more serious. Their words are very, very well chosen, and they do signal to the market whether they, how close they are. But those words haven't been said this morning, so I think we're okay for the moment. But this time next week, or as we come in closer to the Bank of Japan meeting, that's going to hot up a lot. But I do think they want to keep their powder dry until they, have to act, and hopefully that's out of choice, where they can act more or less to add liquidity on the way down and all that sort of stuff. I don't think that they're going to, try and catch the market out at all. They've been pretty well signalling what their intentions are all the way along. And in the meantime, the market's still, and like I said, as far as that CPI print, the 10-year US JGB spread is out now to, I think, 360 points. Now, when dollar yen was like that before, was around 147 back in late November 23. So if if we get up to that 380-point spread, we might see a situation where, like it was back in November, dollar yen was in fact above 150. So that the dynamics of the market are still intact, and if we see that spread widening, then people will become a little bit more comfortable with their longs. I wouldn't especially be entering into a long above 150 myself. I think dollar yen took off from 149.35 when the US CPI print came out, and if we see any pullback to around that level, 149.50, I think it'll be bought into quite convincingly.
Michael Wilson, our FX and rates reporter there with the latest on the yen. And to that point, we are now hearing from the Finance Minister, Shinichi Suzuki, speaking in Tokyo, saying that FX should move stably, reflecting fundamentals, and rapid moves in FX are undesirable. Watching the Forex situation with a strong sense of urgency. So really reiterating some of the same sentiment, the sort of verbal jawboning that we did hear from Kanda a little bit earlier on the top currency chief. But of course, the weakness in the yen has been one of the supportive factors for trading in Japan equities, and the Nikkei 225 again edging closer to an all-time high. The stock average seeing its biggest advance on Tuesday since November 2022. Let's get more from our Asia equities reporter Winnie Su, who joins us in Tokyo. So, of course, last year was a banner year. We saw maybe a little bit of a breather for traders that have been so bullish on Japan. But this recent momentum, this revival again, what's been driving that?
Right, recent momentum is really strong, and I think that caught a lot of strategists by surprise. And strategists have been hiking their targets for the Nikkei and the topics for the past couple of weeks. And we're seeing that momentum really been driven by obviously the weaker yen that you mentioned, now past the 150 against the dollar, but also the ongoing corporate governance reform and the continuous foreign buying for the past 5 straight weeks. But something special about the recent trend is also the positive earnings from major caps, like we saw Toyota hiking forecast, and also SoftBank rising on the ARM rally and also positive earnings. And some of the chip companies were doing pretty well with their earnings as well.
Tokyo Electron share price rising 13% to a record high on Tuesday after earnings. What were the drivers behind that big reaction?
Yeah, so the stock price really surged after the company said that they were going to hike the forecast on the strong China demand, and which accounts for about half of their total revenue. And that really came after how the U.S. decided to have the trade curbs around the advanced chip technology to stop China from gaining those technologies. So China had to continue to purchase such technologies and equipment from other countries. So that's been really helping Japanese chip companies, which is actually a really big contrast when you compare that with some other China-exposed Japanese equity names like the electronic names or the factory automation names that really struggle in this earnings season due to the economic slowdown in China, as well as the property trouble that we're seeing in the country.
And more broadly, how's the earnings season been going so far?
Overall, I would say it's pretty good. We're seeing actually more positive, more earnings beat than miss. And people have been also looking at the corporate governance reform, saying, for example, you see a major buyback from Mitsubishi Corp, but also buybacks from companies that usually don't announce such information. And also the volatility is quite high at the earnings season. This time you're seeing the stock price is really swinging with the results. And people cite that's probably also because we're seeing more new investors come into the Japanese market to try to understand what's going on in the market. But I would say overall, it's pretty positive.
Our Asia equities reporter Winnie Su there in Tokyo. Coming up next, the Commonwealth Bank CEO warning of risks to the Aussie economy after the lender's profits topped expectations. We get the details on the messaging next. This is Bloomberg. Well, Korean Airlines is one step closer to acquiring smaller rival Asiana. The EU has approved their $1.4 billion merger deal as Korean Air offers to sell part of Asiana's cargo business and enable entry for competitors on certain passenger routes. The merger is still requiring regulatory approval from the United States. Paramount Global is said to be cutting 800 jobs. It's about 3% of its workforce after hosting a record-breaking Super Bowl TV audience. The move was widely expected amid a company-wide restructuring aimed at cutting costs and reducing debt. Paramount's bottom line has been pressured in part by continued loss of TV subscribers to streaming services. Bloomberg has learned that Standard Chartered is considering restructuring its institutional banking arm. The revamp would be the latest effort by CEO Bill Winters to improve the bank's returns. Sources say the lender is weighing options, including separating the investment bank from its corporate and commercial banking operations. Well, Commonwealth Bank CEO Matt Commons says risks are mounting in the Australian economy after the lender's profits topped expectations. Let's bring our finance editor Adam Haig for more. And Adam, you know, the numbers are a beat, margins clearly under pressure, and the messaging was not so positive.
Indeed, and margins, of course, continue to be the main story. And, you know, 11 basis points or so of loss in the first half. So clearly it's an ongoing story. But, of course, as you well know, CBA has tried pretty hard to kind of keep that position in that home lending market pretty keen. They've been willing to discount a little bit less than some of their competitors. So they have sacrificed a bit of market share there. And that's been a key strategic decision from Matt Common and some of the senior leaders at CBA. I think really what people are looking for here is 6 to 12 months down the line, how does that continue to be impacted? Clearly, there's a lot of money on the sidelines that their bank has to potentially do some more on the buyback side. The dividend today at $2.15 was a little bit ahead of expectations and was pretty reasonable in the current climate. So really, the comments around the economy and margins are really the main focus, and it's a tricky one to kind of see how it plays plays out, because of course the share price has done very well in the last kind of 3 months. Has run up really hard. It's come off a little today, 2.5% in early trading, but it's not a story of kind of suddenly the wheels are coming off. This is kind of an incremental downgrade to forward numbers. The big thing, margins continue to be pressured, and it's a very competitive landscape still for home loans in Australia.
Yeah. Pressure has been obviously on home lending, but in terms of the fixed rate mortgage situation, are we sort of past the worst? And particularly if you take a look ahead to the expected outlook for monetary policy?
I think it's reasonable to assume we are through the worst, and if you look at the CBA numbers, they say that most of their customers have already rolled on, and there's still a decent chunk that will have to roll over in the next 6 to 9 months away from those pandemic era fixed rate loans. But of course that competition is still there. They're seeing a little bit less flight of people moving onto competitors, but still that's something to keep your eyes on over the next few months.
Finance editor Adam Haig here with the latest on CBA, and take a look at how broader markets are trading at the moment. We were expecting really that follow the loser, if you will, given the reality check that we saw US markets really have overnight with that hotter than expected CPI print, sort of a lot of realignment and repricing going on when it comes to Fed expectations and easing expectations. We are seeing downside here in Sydney of about 1.3%, but interestingly, you know, a little bit off those session lows, if you will. We're watching in particular trading on the FX front as we get into just about 5 minutes away from the start of trading in Japan. Nikkei futures looking pretty negative at this point, and we are seeing the yen sitting firmly above that 150 level. Just hearing from the finance minister just now, really talking about the undesirability of rapid FX moves. Coming up in the next hour, talking more about that US inflation print likely to stall any Fed rate cuts. We'll be talking market strategy with Julius Baer. The market opens in Seoul and Tokyo are next. This is Bloomberg.